Welcome traders. So today we're doing a little bit of a mini trading. We're going over the rules of mechanical trading, how to basically build your own system. And we'll go to the charts towards the end and just create a simple mechanical system based on the things that we talk about today. Mechanical trading is very simple. It's if A happens, you do B. Everything's objective, black and white, zero gray area. And what this does is it helps your performance. It helps you trade better. It's a fact. The data backs this up. If you look at the stats between mechanical traders and discretionary traders, mechanical traders have a higher success rate. And the reason for that is it takes away that subjectivity. It takes away that discretion, which is what causes a lot of traders to spiral and end up trading emotionally instead of logically. And there's a lot of reasons that we're going to go into today why mechanical trading helps prevent the emotional side, which is absolutely crucial. So, yeah, if A happens, we do B. And basically, every decision is just if then, and that's it. Really that simple. Now, this might seem obvious, but with a mechanical system, you always have to ask yourself, what's the most objective way of defining the next step? So, with that question in mind, let's start off. How to make it objective? What tools can you use? What are the methods to create that mechanical edge? One of the first things we can use is indicators. And why? Because they're very objective. Now, we obviously don't want to be adding loads of different indicators and making your charts look like Star Wars and all that stuff. We just want simple indicators and ones that you can use EMAs. You can use the average true range. These are really good ones. I also like to use when creating mechanical systems, and we'll go into why as well later on. And obviously, you can actually use price action itself, but you just have to make sure that the rules are systematic, really objective, really define if this happens, then we do this. That's the rule. So price action, yeah, you can use price action as well, but only certain price action tools. We don't want to be using trend lines, support and resistance. That's when it gets subjective. Everyone draws that differently, and it can just cause that hesitation. There's some of the tools that we can use. Why the EMA is good, we can use these as trend filters. So let's say, for example, if price is above the 200 EMA, we only look for longs. If it's below it, you only look for shorts. That's another yes or no criteria. That's how you can define your trend. So that's where the EMAs can come in handy for that. It can also be used as a trailing tool as well, an area of value to trade off because it can act as support and resistance, dynamic support and resistance, and it's very objective. So EMAs are great. I love them. So how the ATR works is the standard setting is 14, and it will look at the last 14 candles and the average movement of it, and it will give you the average range of what these candles are moving. And we can use that because it gives us a good idea, for example, where to put your stop loss. Okay, if the market's moving, let's say 30 pips on average, we want to put our stop loss at 31, just a bit higher. Therefore, we can avoid getting wicked out. So it can help with that. Again, the ATR is good for trailing. We can use an ATR-based trailing stop, also known as a chandelier exit. So these are the few things. When we go to the charts, we'll cover it a bit more. And next up, we'll go to the difference between a robust and fragile system. Now, this is very important. What a lot of traders tend to do is they over-optimize the strategy. They try and curve fit it. They try and make it perfect. And what happens? It actually becomes a fragile system. If you remove one of the things, it breaks. So let's say, for example, you've optimized it for this one market, or if you change it to another market, suddenly you've got no edge. That's because it's a fragile system. What a robust system is, it tends to work on most markets. If you change to one to the other, it tends to work. And that's a robust system. That's the kind of system you want. You don't want to curve fit it. So understanding that, making sure we don't create a fragile system is key. And how do we do that? It's very simple. Simplicity. Keep the edge as simple as possible. And therefore, the less variables, the less noise, the more robust it becomes. Okay, we don't need to add more and all that. So that's the difference between a robust and fragile system. With a mechanical edge, what's very important is making sure we use static risk and it's always predefined. Basically, a mechanical system, we look at probabilities, we look at the large number, we look at the math of trading. So if you've not seen this video that I posted a while ago, it's all about probabilities, how it works. I'll put the link below. give that a watch. Now, what's important with mechanical system is we use static risk, but we also make sure we avoid the risk of ruin. So this is where once we've tested it, we can work out how well it does with certain risk to rewards, and then optimize the risk percent to fit that so you don't blow up basically. Let's say you risk 1% per trade. That is your predefined static risk. You never change from that. You're not doing dynamic risk. You're not saying, oh, this is a high probability setup, I'm going to risk 5%. Or no, this is a rubbish setup, I'm going to risk 0.5. No, none of that. Because what that does is it ruins the edge. The math doesn't work. The probabilities don't play out. So static risk, super, super important. So that's probably one of the easiest things with a mechanical system. Your risk is always predefined. You know exactly what you're going to risk every single trade. Stop loss. Again, your stop loss is always predefined. Maybe it's based on the ATR. Maybe it goes below the candle, whatever. It's exact. You know exactly what you do before you get in. So you know where your stop loss goes. You have a hard stop, and that's it. And it's based on logic, not fear. So going back to what we said before about the ATR, that's based on the volatility of the market. That's logical to base it on that, rather than this subjective level that you're seeing that maybe price could come into some sort of resistance, whatever. This is based on the math, again, I suppose you could say. Now, this next point about backtesting is where the confidence comes from. This is the mechanical trader's true edge, in my opinion. They backtest the system. They test it over 100 trades at least. And I like to do a lot more in over different market conditions, different outlier events. Where most systems fail is these outlier events like COVID or financial crashes. That's where the edge gets destroyed. I want a system that's robust and works in them conditions. So that's why the testing is important. You need to be able to go back, see how it performed, how it recovers when it hits drawdowns and things like that. And what this does is it gives you confidence. So when you're trading live, you know what to expect. You know what the average drawdowns is. You know how the system works because you've seen it. So this is also important. So yeah, once you've tested, you know what your win rate is, your average drawdowns, your average risk to rewards, all that stuff. And I just put there at the bottom, you're not going in, I'm hoping it works. You've seen it work. That is the difference with the mechanical system. So how do you exit a trade? This is where a lot of traders go wrong. Again, the exits are created on fixed logical rules. So you can have fixed targets. That's a yes or no. If it goes to 3R, then I'll exit the trade. That's a fixed stop. Or maybe it's if it closes past this EMA, then I exit. That's how we make the exits objective and easy. So you know how you're going to get out before you get in, which is absolutely crucial in this game. Most traders do the opposite. They rush to get in and then they don't know how they're going to get out. And that's where they let the fear, the greed, the whatever, all start to kick in. And finally, with the journaling, what's important is comparing it to the back test. Is it doing what you tested? Is it the same thing? If it is, great, carry on. And if it's not, then you look at the data and see, okay, what do I need to refine? Is there something that needs adapting here? But you wouldn't know that if you're not collecting the data. So how I like to do it is every day I write in the trades and I review every batch of 20 trades. And what this does, it's just large enough for the probabilities to play out, the law of large numbers. And you can compare it to the backtested data. And it's just small enough not to blow up your account or stick with a losing strategy. It's just small enough just to double check things. So let's go to the charts and just create a simple mechanical strategy based on what I just showed you. So here we are on the chart. So let's just create a very simple system. Let's first bring up the 200 EMA. Here we are. We've got the 200 EMA up. So what could we do with this? There's a couple of ways we can use the 200 EMA. One of the ways that I discussed a minute ago was using it as a trend filter. So for example, if price is above the EMA, which it is here, we only look to long. So you can see in this instance, going for longs would have worked out well. If it's below the EMA, so we only look for shorts. So that's a way you could use a trend filter. I'm going to do something a little bit different just to make the entry, the buy and sell engine a little bit easier just for this example. We're just simply going to say, if we get a close past that 200 EMA, we go long or short. So we can see here, it goes long. That would have been okay. Goes here, probably would have lost. So I'm not talking about the trade management yet. I'm just talking about the buy and sell engine. So long would have been loss. So you'd had a few losses going up and down that 200 EMA. Eventually, you'd have got a nice win here that would have paid for a few of the losses. Here, you have a little bit of in and outs. And again, you'd have caught a big trade that would have paid for all them losses and more. And if we look at this one here, this would have been a fantastic one. Loss here, loss there, win here. This would have eventually created the majority of the profits. And then finally, we had this one over here as well. That would have been the home run. That would have been the big winner that you'd be holding and you'd be making all the profits. So what trade management could we use with that simple buy or sell engine is that ATR. So I'll just bring that up. So I've just brought up what I call the chandelier exit. If you just bring up this here, the trading view, chandelier exit or chandelier stop, they're both the same thing. Basically, you can use this as a trailing stop, or you can put it where you want the stop loss to be as well, in fact. But let's say you enter a trade and you can use this as your exit point. So it never closes past below that, doesn't even close past there. And you can just keep trailing your stop as it goes until you get exited out, close past that ATR. So that's one way of doing it. This could be your exit model. So I'm just going to cherry pick an example. Obviously, there's going to be losers and stuff, but I just want to show you the trade management, how you can do it. So we've got a long setup here. We enter market there and we put our stop loss where the ATR is. Okay, so it would have been down here somewhere. And you only exit once it closes past ATR. So when did it do it? Would have been here, around about there. So I'll just drag it out so you can see it a little bit better. So you can see price closed past that ATR right there. So you've made a bit of profit there. Okay, so that's how you could use the ATR. Another simple way, if you didn't like the ATR, you could use the 50 EMA. So we could use this as an exit. So if you go long here, you'd have exited when it closed past there. If you go short here, you only exit once it closes past the 50. So let's say you entered on this one. When it closed below, you hold it until it actually closes past the 50. So it never closed past. And then you'd still be holding it until we go down here for this one. So that would have been a nice trade. And then we can look at a long. You've entered on this, never closed past that 50 until here. And this is just a very simple mechanical strategy. I just really made this up. It's not one that I personally trade. I just wanted you to see how simple you can make a system. You create an objective rule for your buy and sell engine, and you create an objective rule for your risk, and an objective rule to get out of the trade. As long as you win more than what you lose, you're going to be all right in the long run. And as long as you're using that static risk, where you don't end up having that risk of ruin. So this is just a simple way of showing you to make a mechanical system. And then you just have to make sure you test it, verify it, and you can optimize things a little bit to make sure it's a bit better. Mainly your trade management, maybe should go in for partials and letting it run, or fixed targets might work better. That's how you can just start tweaking things a little bit. But something like this, trends exist everywhere. That's a robust system. If you have a system that catches trends, it's going to end up working on most markets with a trending characteristic. So there you go. So I hope you enjoyed it. And if you did, let me know. And I'll put a checklist down below as well that you can get for creating a mechanical system. So that'll be in the link below. And if you want to learn more about my own mechanical system in the trifecta trading approach, just give me a DM, just comment the word trifecta, and I'll personally reach out, ask you a few questions, and see if you're a good fit, and maybe we could work together. Yeah, thank you for watching, and I'll see you soon.